Welcome everyone to today's webinar on how to get the most from the sale of your business. My name is Bob Stone. I'm a founding partner and relationship manager at Telemus Capital. The objective and the background of this is really where we're going to start, and then we'll bring in our panelists. We started doing this 14, 15 years ago when we started Telemus, working with business owners and helping them figure out the process to how to be a business owner and go to properly selling their company over a period of time. And we had noticed back then that a lot of business owners, it was a last minute decision to make a lot of the most important decisions. And a lot of times they left a lot of money on the table in various respects. So we started this back up this year and decided to do it in a webinar format. So at the very basic, the objective of this webinar is to help you prepare your estate and your company for a transition. And in most cases, that transition is going to be the sale of your business. And what we've seen is many business owners have a very loyal current team of advisors, their CPA, their attorneys, their estate planning attorneys, their financial advisors. And in many cases, it's been the same team that they've been using since the day they started their business. But many times we see that the team has failed to ask the bigger strategic questions that need to be asked 1, 3, 5, 7 years in advance of selling your business. And so the objective of this webinar is to give you 5 different perspectives of the same event, which would be the sale of your company. So what should you do to prepare yourself, prepare your business, prepare your estate, and even prepare your family for the eventual transition, which in most cases is the sale of your business. Who should you have on your team? What should the qualifications of those team members be? And what does the sales process look like? And finally, who should be the quarterback of this entire event? So with us, we have 4 panelists besides myself. We have Brian Hermelin, Ken Wasik, Aaron Sherbin, and Michael Bernard. And just a quick brief introduction on each person. Aaron Sherbin leads the estate and wealth planning practice at Jaffe Raitt & Hero in Southfield. He specializes in trust administration, wealth preservation and transfer, and strategic business planning services for closely held companies and family businesses. He offers succession planning, post-mortem planning, and asset protection. Aaron also serves as a mergers and acquisition transactional attorney focusing on federal tax law, buy-sell agreements, operating agreements, and shareholder agreements. Aaron is a graduate of the University of Michigan with a bachelor's in business administration, has a JD from Wayne State University, and has an LLM in taxation from New York University. Our second panelist is Ken Wasik. Ken is a managing director at Stevens & Co. in New York. He brings over 20 years of investment banking experience covering branded consumer companies, retail and higher growth sectors within household goods, health and beauty, sports and leisure, consumer services, specialty retailing, and direct marketing. He has advised domestic and international clients on a wide range of strategic and transactional services, including M&A advisory, public and private equity offering, debt placement, management buyouts, financial restructuring. Ken specializes in advising high growth, dynamic companies in emerging sectors and channels. Recent transactions have included advisory roles for premium brand skincare company, a national retailer sporting goods, the leading content provider of independent musicians, the largest ebook retailer, the fastest growing e-commerce seller of large consumer electronics, an international luxury good company, a high growth specialty retailer of household goods, and a direct marketing of beauty products. Ken is a graduate of St. Joseph University and has an MBA from Columbia University with honors. Our third panelist, Michael Bernard, is a member of the corporate finance group at Dykema in Detroit. His practice focuses primarily on business counseling and planning with an emphasis on mergers and acquisitions, representing both sides, buyers and sellers, capital raising transactions, including private placement, private equity, seed and venture financing, corporate formation matters, corporate governance matters, and executive employment agreements and related matters. Michael is a graduate of Notre Dame University with a BBA and has his JD from University of Cincinnati. And finally, Brian Hermelin. Brian is the co-founder of Rockbridge Equities, LLC in 2007. He's also the founding partner of Detroit Venture Partners, an early stage venture capital firm focused on creating technology businesses in Detroit, and a principal at Jack Entertainment, an urban gaming company with operations in Ohio, Michigan, and Maryland. Brian sits on the board of directors of several Rockbridge portfolio companies, including North Central University, Connect America, AB, UV Media, Rapid Advance, Gas Station TV, and The Robb Report. And prior to that, Brian was a business owner. He served as a chairman and CEO of Active Aero Group, a leading air charter broker and logistics company. So Brian's been on the table, been on both sides of the table in terms of buying and or selling. Brian has a BBA from the Ross School of Business, University of Michigan, and a master's in business administration from the Wharton School at the University of Pennsylvania. So I'd like to welcome you all, and I'm going to start out here with 2 general questions for our panelists. Then I'm going to have some more specific questions for them to answer, and then finally we'll open things up questioning for all of you. Just so you know, a little housekeeping before we get into questions. You've all been placed on mute. We have left time at the end for questions and answers. If you'd like to ask a question, there is a panel. There's a question box at the bottom of your screens that you can ask those questions. And at the end, our moderator will ask those questions, and we'll have our panelists answer them. So the first general question I have for our panelists, and I'll kind of ask you to each answer as we go along, is what does a perfect situation, a perfect sale look like in your world? So starting from far to close, Aaron Sherbin on the estate planning side, what does a perfect situation look for a business owner of a closely held business look like at the end?
Thanks, Bob. From a estate planning perspective, first the client should surround himself or herself with a team of advisors who are addressing the client's legal, tax, accounting, financial, and insurance needs, and meeting with that team on a regular basis. Second, the client should have a well thought out estate plan developed well in advance of the client's death, disability, retirement, or sale of his or her business. That estate plan would, among other things, minimize or eliminate any income tax, capital gains, and estate taxes. And if there are taxes to be paid, the estate plan should provide the liquidity to pay for them. The plan should also provide for the orderly transition of management and control of assets, including the business, so that family members are provided for and taken care of in a fashion the client desires and intends. The estate plan should dovetail with any business succession plan or buy-sell agreement that's currently in place for the business. The plan should provide sufficient liquid assets and cash flow to support the family. The plan should acknowledge and address active and non-active family members of the business and treat them fairly or as expected. And finally, it should address the death, disability, and retirement scenarios. And then, of course, once the estate plan is developed, it should be periodically reviewed by the client with his advisory team.
Thank you, Aaron. Mike Bernard, from a corporate governance and corporate structure, what do the basics, the best situation look like in your world?
In terms of a perfect sale, Bob?
Yes.
Yeah, so I would add on to the estate plan. I just want to emphasize, as Aaron was saying, make sure you do that early, because the closer you get to actually executing, the less opportunity you have to be creative. I think Aaron would confirm. From my perspective, be prepared, and that would include taking a look at your business, at your corporation, if it's a corporation, it's a limited liability company, the limited liability company, and make sure you understand what sorts of diligence items that you may need to address. You don't want to be surprised through the process. So if you get an opportunity to look at those before, that is huge in terms of reducing the risk of execution. And those kinds of things you would look at would be, are there change of control or anti-assignment provisions that are lurking in your material contract? Are your corporate records in shape? Do you know who appropriately owns the stock, for example? Has it been authorized? Can you find the records and don't need to go through a fire drill at the end? For your key and other employees, do you have confidentiality, non-compete, or IP ownership issues? Let's make sure we understand those and put them on the table early. Do you have any one-off issues that might include environmental, litigation, pension, or other employee benefit issues that you need to address now before you get into the heat of battle? Do you have any special designations as a company? Are you a minority designated entity that has real value to you, but to somebody else, such as a strategic buyer who cannot avail themselves of that designation? Make sure you understand it, because that will affect the value as you get involved later. The last one I would throw in there is to take a look at potentially doing a quality of earnings study before you embark, so that you make sure you've identified issues and can appropriately address them through the process. The last thing I would say is understand what are the norms for post-closing liabilities for a seller, and understand what is market, so that you're not surprised when you get into that part of the discussion. And I think that would be my take.
Thank you, Michael. Ken, from an investment banking perspective, what's an ideal client? What's an ideal corporation? What's an ideal situation?
I think the question was ideal transaction. The ideal transaction is where both parties, both the buyer and the seller, maximize their goals. For the seller, what's important is that they understand all those goals and everyone's on the same page. Those goals can be everything from valuation, having realistic valuations, to management team that they're on board with a transaction like that, to employees that they're taking care of. To the buyer, it's, are they getting a good company? Are they getting what they said they were buying? Is it in a position to optimize from their side? At first glance, these are mutually exclusive, but if handled right, both parties, it is a win-win situation.
Okay, thank you. And last, Brian, from a private equity perspective, and even from a seller who's a business owner.
Listen, I think they're a bit symbiotic. And Ken described it appropriately, which is to say, I mean, as a buyer, right? What we would what would be a perfect situation for us? A perfect situation for us would be to be introduced to a company that's considering a monetization event, and working with the seller to craft a transaction that works for them, works for their employees, and works for us. Absent an intermediary. When I was a seller, however, that's not necessarily how I endeavored to do it as well. I think that there's real value placed by having a financial advisor in that transaction to help you tell your story, present it, and find that partner. I mean, I think that I can think of just 3 P's. I don't want to be cliche, but process, partner, and price, and all of those things need to really check the box for you as a seller, and for somebody as a seller. And when we look at it at something as a buyer or partner, because sometimes these are controlled transactions, and in many times they may not be controlled transactions, or if they are controlled transactions, there's still a significant amount of equity held by the original business owner. And so we want to make sure that there's alignment with the folks that we're buying or partnering with. Make sure that the capital structure of the transaction works, so that the company can continue to grow and deliver on its business plan and take advantage of growth opportunities, and ultimately yield a good outcome for us as investors, and another good outcome for the sellers if they rolled equity into the transaction.
Okay, thank you. So kind of on the opposite is, what are some of the things that the 4 of you, see that business owners do all the time that they shouldn't be doing? So like Brian, in your case, you walk into a situation as a private equity investor, and you're like, oh, great, this guy has done this, this, and this. I don't have to pay him as much, and I get a better deal.
Rephrase the question, Bobby, so that I didn't quite grab it.
What are the things that business owners shouldn't be doing, but typically do in a transaction that kind of help, lower the value of their business?
not being prepared. Not really. I'd rather turn the question on its head and say, what could a business owner do to maximize the value for their business? Because I think that's a better way to go with this thing. And what I would say is, really understand what your competitive advantages are. Really understand your business. Why does it exist? What's special about it? What are the competitive moats in the business that differentiate itself and allow it to continue to grow in the space that it's operating? Really have, particularly for a financial buyer, I'll differentiate a financial buyer from a strategic buyer, because a financial buyer most of the time is not coming to the table with a management team set to run that business. And so really making sure that if you are the operator and the seller, that you've got a team in place to take on the reins of the business in the event that you want to depart, so that the succession plan is in place, the management team is seasoned and is ready to go and continue to operate the business as it was. Really understanding how to tell your story is an important way to maximize that business, and the way you do that is to have as many kind of informal meetings as you can leading up to a transaction process. Meet with a bunch of investment bankers that traffic in businesses in your space. Tell your story to them and let them tell you what they hear and what's attractive and what's exciting about your business, and they'll also kind of share with you parts of your story that need to be flushed out further. And then lastly, I'd say really have a clear, the better you can paint a picture for where this company can go and the growth opportunities in front of it, the more a buyer will look and value those and say, this is, they already have a really good idea where this business can go, and with new capital and new owners, they can go after and tackle those new opportunities.
Ken, do you want to add anything to that?
Yeah, I would say one of the most interesting things is I'm an owner. I've been running my business for 20 years. I know the strength and weakness of the business. Here is why someone should buy. I think actually coming with an open mind, getting the right advisor, talking to the right people, and understanding what you necessarily see as the strengths or what the ideal position of the company isn't maybe not what is ideal for a buyer. I'll give you an instance. Recently sold a company. Basically, it helped musicians get their music out there. They thought the real business was helping the musician record music and get it out there. Whereas the end buyer, what they were most interested was their pipes to get to the internet. And so if the buyer had spent, or the seller had spent a little bit more time thinking through how I would position the company, may not be the ideal positioning to the ultimate buyer. It takes time to go through that. It takes the right advisor. I would say that's where we see really the difference between normal valuations and outlier valuations.
Okay, thank you. Michael, on the corporate governance side, are there issues that you see on a regular basis that may slow up the process, may impede the process, that that you could say, I see these on a regular basis, you should consider avoiding them as soon as possible?
So if you're a family-owned business, make sure the others in your family have a shared opinion as to what you want to do. That can put you in quicksand quicker than anything else. Not quite corporate governance, but make sure that as a seller, you're mentally prepared to go through with it. Oftentimes people start down the road, but then they get a little seller's remorse, and that is aggravating for everybody. The third thing I would say is echoing some other comments, make sure you have qualified advisors who have been through this before and do it as a regular part of their business. Nothing can be harder to work through than somebody who thinks they know what they're doing, but they're really not, because they can't give the buyer good advice as to what is normal and customary and those types of things.
Okay, thank you. And Aaron, this is kind of, I think, always, estate planning is always a macro, longer range planning. But once again, do you see common mistakes that people make with estate planning that are easily avoidable if, teeing this up, planned ahead and planned in advance?
Yes, Bob, I would categorize the don'ts into to 4 areas. 1 is liquidity, 2 is timing, 3 is communication, and 4 is a written plan. As far as the liquidity is concerned, depending upon the size of the client, the business owner's estate taxes may be owed, and they may be owed at the rate of 40%. And those estate taxes are due within 9 months. So if you don't plan for liquidity, you could have a situation where tax is due within 9 months, but you don't have the cash to pay for it because the estate is made up mostly of business and real estate. That would force the family to perhaps have to sell the business under circumstances where they have little or no leverage and are unable to realize the company's full value. I think Michael alluded to this. You got to communicate the plan and make sure everyone is on board, including family members and key employees of the family. Oftentimes I see clients relying on a handshake or trust in making sure that their intents and desires are going to be carried out after they die. And I can tell you that if you fail to have a written plan in place, you're likely to, the client's likely to result in unsatisfactory and unintended disposition of the assets. After death, you could have expensive litigation between family members and business partners, and you can create fractured family relationships. The other thing is, waiting to the last minute. Again, so you're not maximizing value, and you're not allowing for the type of disposition of assets and planning for members of the family who are active in the business and non-active in the business the way you want.
Okay. Anything else you want to add, Aaron? Not for now? Okay.
That's it.
So now we're going to move on to advisor-specific questions, some things that I've prepared. I'm going to kind of call out the advisors and kind of have them ask questions as we go through the process. So Ken, you're first on the hot seat. Should I, as a business owner, talk to buyers before I'm ready to sell my business? And what do I do with inbound calls before I'm ready?
Always take inbound calls. Whether you're for sale or not, always a good thing in everything in life to take an inbound call. As far as inbound calls with interest to buy you, take those calls. An easy, hey, maybe there's something to do long term. I'm not a seller right now, but could you tell me why you're interested in our business? Could you see why a partnership would work out? Is there something we could do in the meantime that we could both advance our own businesses? So always take calls. I advise clients, even when we're prepping for a sale, don't say you're necessarily for sale, but take those calls. Always take calls.
Okay, thank you. Brian, can you explain to our audience what the difference between a financial buyer and a strategic buyer is, and what do financial buyers look for that is different from strategic buyers?
Sure. Well, I kind of alluded to it a little bit earlier, but yeah, I mean, a strategic buyer is a buyer that is either operating in the direct space of your business or in an adjacent business to your business, and as a result has a particular insight into your industry, into your company, and more likely than not has some synergies, some cost synergies or revenue synergies that they can take advantage of through an acquisition of your business, and they will oftentimes be your best price. However, there might be a cost to your employee base that you need to be sensitive to, because oftentimes those cost synergies end up in a reduction in workforce in either the acquirer or the target. Whereas a financial buyer is probably in most cases has been doing work in that space and has Ken referred to it, has a specific angle on the business that's either directly related to where you believe your business is going, or has a perspective on where they can take that business in a way that perhaps the current owner hasn't even considered. And and they'll be using primarily a combination of equity and some kind of debt, and there'll be less synergies. They'll be much more reliant on the management team to deliver on that business plan. Some firms will come into your business, and you really need to understand what the investment thesis of the financial firm that you're partnering with is. But this is somebody that tends to come in and manage real operational efficiencies, and may themselves reduce headcount significantly to kind of come in and what they'll say is right size the business, versus folks that are investing in a growth plan and are investing to accelerate and grow the business, and putting money into the business to sustain and accelerate growth. So the financial buyers will tend to be looking at the business on a standalone basis, not in relation to their own business, whereas a strategic buyer will be having a broader set of considerations.
Thank you, Brian. Aaron, for a business owner who believes that the sale of his or her business will be successful enough to leave them with more than enough money for the remainder of their lives, and who has desires or wishes to transfer wealth either to family members, other family entities, or for that matter, charities, to maybe reduce capital gains and estate taxes, are there estate planning techniques a client can implement to maximize the amount that they can go to family and charities and minimize the taxes? And how far in advance of selling your business should you be doing this?
Yeah, so I think before I get into the actual techniques, a brief overview of the tax landscape is instructive here. So currently, taxpayers can avoid paying estate and gift tax on transfers of assets during their life or a death of up to $11.4 million. That's what we call the exclusion amount. And that's per person, and it's portable. And so between a married couple, they can effectively transfer wealth of up to $22.8 million without paying any estate or gift tax. I will point out, however, that exclusion amount is automatically dropping down to $5.5 million per person, or $11 million per couple, on December 31st, 2025. And of course, if you do have a taxable estate that exceeds whatever the exclusion amount is at death, for now, that estate tax rate is 40%. Another rule to keep in mind is that upon death, the taxpayer's basis in their assets will be stepped up to the asset's fair market value at date of death. So for example, let's say we have a client who owns a widget at his or her death that was bought at $4. And so the cost basis is $4, but at the time of death, it's worth $10. When that asset passes on to the client's family, that family member will take a basis of $10 in the asset, not $4. So you've effectively wiped out any unrealized gain in that asset when you've passed it on at death. So what I'm trying to get at here is, because of the high exclusion amount, $22.8 million for a married couple, in some cases, estate tax planning becomes less important in the process, and income tax planning takes on, the tax planning and the step up in basis at death takes on a more important role. Now, on the income tax side, you've got capital gains rates of either 15% or 20%, depending upon the client's taxable income, and ordinary income tax rates, when you factor in federal and state taxes, of approximately 44% for a state of Michigan resident. So you have to consider and plan for the likelihood that there's going to be income taxes or capital gains taxes owed when you sell your business, number one, and then a potential for a second tax, estate tax, to be owed on the assets realized from the sale of the business at death, effectively a double tax. So obviously maximizing what you leave to your family and minimizing what you pay in taxes requires careful planning. So with that in mind, I find that there's generally 4 techniques that are used and should be considered, well before the sale of the business to help transfer wealth and maximize what you're sending to family members and minimizing what you're paying in taxes. The first one would be gifting business interests to family members, either outright through a family limited liability company, partnership, or trust. This technique usually involves the creation and gifting of non-voting business interests because the value of a non-voting business interest can be discounted for lack of marketability and lack of control. So by taking those discounts, we're effectively leveraging the use of that exclusion amount. We're shoving into the exclusion amount more assets at a discounted value by the use of discounting and non-voting interest. You then can control the disposition of those assets gifted through a trust or a limited liability company or limited partnership, depending upon the terms that you provide in those documents. So here are some of the key takeaways from this technique. Number one is to make sure that you do this well in advance of a sale, where you don't have a market, a letter of intent, an intent or desire which pegs or provides for a value that's higher than maybe the value well before that sale. You'll want to get a valuation of the business and a valuation of the discounts, because we recommend when you use this technique, you file a gift tax return to begin the statute of limitations running against an IRS audit. And when you file that gift tax return, you have to be able to substantiate your value and your position, and you can do that with an appropriate valuation. Finally, with this technique, I would point out that there have been some recent IRS cases that have attacked the use of gifting through a family limited partnership or LLC, where the family member, the matriarch or patriarch, has made gifts of interest in an LLC or family limited partnership to younger generations, but have retained control of that LLC or partnership, either through serving as a manager or general partner or holding voting interest. So you'll have to be careful that if you're going to use this technique, you avoid the application of these most recent tax court cases. The second technique is a sale to an intentionally defective grantor trust. And under this technique, you would sell the non-voting interest as opposed to gifting it to an irrevocable grantor trust in exchange for a promissory note that's paid over a fixed term. Typically, we suggest that the term of the note be no longer than 9 years, and the interest rate to be charged on the note has to be at least the minimum rate of interest required by the IRS. Those rates are at historic lows, and in fact, I just checked, the rates for November on a midterm note of 9 years is only 1.59%. So some things to consider about this technique is, number one, it's a grantor trust for income tax purposes. So what that means is the grantor is treated as owning the trust, and so if the business owner sells the interest to a trust of which he's a grantor, there is no gain recognized, because in the eyes of the IRS, the business owner is treated as have sold the asset to himself or herself. Number two, in this technique, you retain a note that pays you interest and principal, so you're retaining some cash flow that can support you and your family. In the first technique, it was a gift of the business interest, so you were removing that interest or business interest off your balance sheet completely, and all the future appreciation as well. With this technique, you're essentially freezing the interest at the date of sale and keeping on your balance sheet a promissory note that won't grow. In fact, it will reduce over time as principal interest and interests are paid, and you're removing the future appreciation off the balance sheet. Number three, because it's a grantor trust, the grantor, the business owner, will have to recognize any income that the trust recognizes. That could be distributions, profits, dividends, or a gain on the sale of the company. So while those dividends or gains from the sale of the business will come into the trust and benefit the beneficiaries of the trust, the grantor will have to pay the tax on that. That may seem a harsh result, what we call phantom income, but what happens is the business owner is paying those taxes for the benefit of the family members and making what we call an effective gift without it being recognized as a gift by the IRS. Third would be a grantor retained annuity trust. This is also a gift to a trust where you're making a gift and taking back an annuity over a certain term of years. This technique is not so beneficial if you're looking to gift assets to grandchildren and great-grandchildren because of the interplay of the generation skipping transfer tax and the exclusion rate. However, you can do this gift in the fashion where it's a zeroed-out gift, so you're providing a gift to family members without any gift tax consequence. The final thing I would say about this technique is you have to outlive the term. If you die before the annuity term ends, everything is included back in the estate, and so there is some risk with this technique. The fourth and final technique is charitable giving, and that can take the form of donor-advised funds, family foundations, charitable lead trust, or charitable remainder trust, and depending upon the client's inclination to make charitable gifts, whether they want to benefit the family on the front end or the back end, whether they want family members to be involved in charitable planning and giving and create a legacy, would dictate which one of these types of techniques would be used. So those are generally the four techniques that I see in the sale of a business.
Thank you, Aaron. Mike, what tips do you have for a corporate, as a corporate attorney, for getting prepared prior to embarking on a third-party sale process?
I kind of talked a little bit about this before. It's really taking a look at the landscape of your business and doing what we call a red flag due diligence review. What are the larger issues that may come into play? The change of control, anti-assignment, are your corporate records in place? Do you have appropriate confidentiality, non-compete, IP ownership issues ironed out with regard to your key employees, with your customers and suppliers? Identify one-off issues you may have out there that you know you're going to have to address when you have a conversation with prospective buyers. Do the quality of earnings report and be aware of any special designations you have as a minority-owned business that may give you particular value that could disappear with a buyer that does not have the ability to have that same designation. So in a nutshell, it pays to pay a little bit of money in advance of the process to make sure you ferret out what are going to be the potential issues so you have good answers and or can fix them before you get down the road.
Thank you. Brian and Ken, do I need, as a business owner, do I need an investment bank, an investment banker? Brian?
For a transaction or a pre-transaction?
Brian, I want both sides. Brian, go first.
Do I think you need an investment bank? I think investment banks provide a valuable service for business owners. They help. They will help guide a business owner, particularly one going through this process for the first time, prepare the materials that a buyer is going to want to see, organize a data room of relevant documents that you're going to need for the buyers to go through, package the story and the business and its position in its industry, and give an industry and help develop the industry overview so that the buyers really are led to understanding the business in a way that perhaps they wouldn't get to on their own, and ultimately for the sellers to maximize a competitive process. I think that from a buyer standpoint, particularly buyers that are spending time in an industry and knowing the businesses in the space that they're looking for, it's certainly you can both maximize both your price and fit. Oftentimes, if you transact outside of an investment banking relationship, so we just closed 2 transactions in the last 2 weeks. One of them was done without an investment banker. We just negotiated. It took a lot longer because there was no data room prepared and a lot of materials we needed to build from scratch to facilitate the transaction. But we understood the business and and they understood the value of our partnership. And the other one was one that we transacted through an investment bank that reached out to us because they understood the spaces that we were actively investing in and felt that we were a good fit for the business. And so and the investment banks can do that for you. They'll put you in front of the right buyers. But I'll let Ken take it from there.
Ken?
I'd say it's situational. There's times to hire one and there's times not to. I'll give a couple instances. Number one is size. Your company may not be large enough that a investment bank fee is worth it. It might eat into your equity. 2, it might be a situation where the ideal buyer is confronting you, and a large part of what the investment bank does is ensuring that you're out in front of everyone to find out who the right buyer is. But if that right buyer is already there, it's the best buyer. There are several transactions that can be handled by good counsel that's been and I'd say it's situational. I'd say the most typical one is where you are a seller, you're not sure of who is the best buyer and who would meet your best goals, and you need a process to figure it out.
Okay, thanks, Ken. So now I'm gonna kind of go to another phase, and I stole this idea from some podcasts I listened to, and they're more rapid fire questions. So I'm gonna kind of throw out questions. Hopefully our panelists can answer them with 1 or 2 words or quick answers after that. So Brian, actually no, Ken, what's more important, growth or profit?
God, I hate to punt, but it really matters the sector. I would say for smaller companies, it's growth. For well-established companies, it's profit.
Brian, do you need audited financials as a business owner?
It makes the process a lot easier.
Okay. Ken?
I would absolutely agree. It adds credibility to your company. I'd even go further at saying quality of earnings takes it even a step further.
Mike, what's the best corporate structure for a business owner to have and set up prior to being to sell his company or her company?
Usually a limited liability company, and if not that, if you can thread the needle for subchapter S, do that.
Mike, Ken and Brian, how long does the process take?
For a full sell side, approximately 5 to 6 months from day you talk to investment banker to day it closes.
Aaron, do you have any advice in terms of assembling your team and who should be the lead on that team?
Well, as I mentioned earlier, I think a team is mainly comprised of legal counsel, accounting, financial and investment advisory. And I typically find that the investment advisory person usually takes the lead on organizing and facilitating the meetings.
Okay, thank you. Brian, is it important for the owner to stay involved or stay at the company post acquisition?
Again, it's situational. If the owner has already established his transition plan, if there's an executive officer in place that is essentially acting as the chief executive officer, then it's not essential.
Okay. And this goes back to some questions we've asked earlier, but who's gonna, if you want to maximize your value, who's a better buyer, strategic or financial? Ken?
Boy, that's a generalization. I'd say all things being equal, If it's a strategic within your industry, theoretically, they should be able to pay more because they'll be able to share in the value of synergies, all things being.
And you know, Brian, in some cases, PE has gotten a good reputation. Sometimes it's gotten kind of beaten up over the time. And what's the benefit of working for, you know, being bought by a private equity company versus, you know, General Motors or GE or some other large acquirer coming in? What's the benefit of coming to a private equity fund like yours to be bought as a business owner?
I alluded to it earlier, right? I mean, you know, oftentimes private equity will provide you a flexibility and ownership that a strategic buyer won't offer you. They'll be typically buying your entire business, and so you'll have the flexibility of staying into the business and participating in what might be a second bite of the apple that could be really meaningful for you. The business will perpetuate in a strategic transaction. You know, the synergies that we referred to earlier oftentimes result in job losses. You know, with private equity, particular private equity that are investing in growing businesses, that tends not to be the case. And so you know, as you think about your broader stakeholders and not just you as the equity holders, private equity can be a great partner that way. They'll invest in your business. They'll partner with your management team. They'll allow you to roll equity in. And if they're good investors and deliver the kind of financial returns for their investors that they endeavor to achieve, you can have another meaningful remuneration event, and your employees can participate along with that as well.
Okay, so we're coming to the end. I want to be cognizant of taking no more than an hour of your time. We've got about 10 minutes left. I know there's one question out there for all of you who might have questions in the back of your mind. There's a chat box on the screen at the bottom that you could ask questions. I'm going to ask our host and moderator, Matt Rand, to read the one question that we have, and then I've got a couple other questions if we don't have anything beyond that. Matt, go ahead.
Okay, so one question. It's a few. How do you value a solo labor law practice with 100 large corporate clients over the last 20 years? What type of professional is best for valuing this type of law practice?
Anyone want to take a swing at that?
Maybe the lawyer will. It's Mike Bernard. I think I'm not sure there are many professionals involved that are financial advisors for just law firms, although there are a handful out there. Probably talking to another law firm is the best way to figure out what that's worth and whether you as a professional running that law practice need to stick around and for how long.
Okay. Matt, one other question?
Yep. How does an investment banker get paid?
Typically, it's if it's a full sale of the company, it's as a percentage of the total value raised or the total value on the company, commonly called total enterprise value. That's the most typical fee arrangement, and it's always or should always be on a success basis. You don't pay the investment banker unless you successfully transact.
Thank you. Matt, another question?
Yep. Who is best to value a 35-year landscape design and build company, not lawn maintenance, with $4 to $5 million in sales?
That's going to be professional services. So you'd look for a banker that operates in the professional services, landscaping, janitorial services. There's absolutely bankers out there that specialize in that sector.
Okay. Matt, any other questions before we close things up?
Yep. What's the percentage for the investment banker?
We're negotiating.
I'm going to take that as what is the typical fee arrangement. Yeah. It's, as I said, as a percentage. You can have fees. I would say the average fees run anywhere from 1% to 5%. Again, situational.
Okay.
Wait,
one
got
more question.
another question.
Matt?
Got two more actually coming in. If the
Okay.
Dems win this year, what do you feel will change?
This is Aaron. I'll take that. We talked earlier about the exclusion amount currently being 11.4 million and dropping down to 5.5 million at the end of 2025. I think it's safe to assume that if Democrats take control of the White House and Congress, that the estate and gift tax landscape now will be a high priority by the Democrats, and I wouldn't be surprised if that 11.4 million legislation is proposed that would drop that $11.4 million down substantially before 2025.
This is Mike Bernard. I just want to add too, we're just completing our 15th annual M&A survey that will be announced the first week of November. And I can tell you that a very high number of responders have indicated that if the Democrats win, and if they change the favorable corporate tax laws that went into place a couple of years ago, that will really put a headwind on M&A deals and valuations.
This is Ken Wasik. I would generally say as a rule, don't try to time the market and don't try to outfool the market. If you believe you're going to sell now because the business is going to go soft in the future years, most buyers will find that out and you're going to lose credibility. On the flip side, I don't think we've seen so many potential headwinds coming up in a while. You've got a 10-year business expansion cycle. You've got a presidential election. You've got Chinese trade tariffs. There's always some noise out there in the market, but we've been advising clients that you may be taking market risk and you may be taking a decision that I'm either going to sell in the next year or I'm going to sell in the next 5 years.
And I'm advising clients now to seriously consider making gifts before there's any change in the tax legislation. There has been, IRS rulings that have indicated that even if you make gifts now with the higher exclusion amount that later drop down to lower amounts, there will be no clawback or tax penalties. So now's the time to take advantage of these high exclusion amounts before they change.
Okay.
As a follow-up to that, then what are you telling clients now about a transaction now?
The market is firing on all 8 cylinders. The debt markets are open. The markets are still flush with cash. The private equity market is as good as it's ever been. Strategic buyers are still being rewarded for making good acquisitions. I'm saying the market, when you compare it to historics, is still firing on all 8 cylinders. There's no reason not to go to market right now.
Okay.
And another one? Who's the best to value my established personal training business?
I'll take that one. This is Ken Wasik. Again, you're back in the professional services realms, and there's absolutely bankers that deal with professional services, whether it be a consulting company, a janitorial, or anything like that. Definitely falls in professional services.
Okay, we're at 2:25. Any of the 4 panelists want to make a quick closing remark before we sign off at 2:30 and keep to our time horizon here?
Yep.
Okay. With that, I want to thank all of you for joining us. If there are any follow-up questions that you forgot or didn't have time to ask, please email me. My name is Bob Stone. My email address is rstone@telemus.com. We'll be posting a replay of this on our website as well as our YouTube channel. If you need access or need help finding that, please let us know. And I want to thank all of our panelists, Brian Hermelin, Mike Bernard, Ken Wasik, Aaron Sherbin. Thank you for your time and your insight. We all appreciate it. And have a good day, everyone. Have a good night.